Liquidity and volatility are words people repeat constantly. But until you've lived through a few real market storms, you don't understand that they are not concepts. They are conditions, and conditions decide whether skill even gets a chance to matter. I learned this the hard way, watching good ideas fail, not because the thesis was wrong, but because the environment shifted underneath them. Price is what you see, liquidity is what allows price to exist, and volatility is what exposes how fragile your assumptions really are. And if you ignore that relationship, the market will eventually introduce it to you in the most expensive way possible. Liquidity is about permission. Permission to enter, permission to exit, permission to change your mind. When liquidity is deep, markets feel forgiving. You can be early and survive. You can be wrong and adjust. Spreads are tight, fills are clean, and mistakes don't immediately punish you. That's why liquidity is dangerous when you don't respect it. It teaches bad habits quietly. During the dot-com era, liquidity was everywhere. Capital was cheap, participation was broad, and exits felt guaranteed. I watched traders confuse that environment with personal brilliance, not realizing that liquidity was cushioning every error and hiding the real cost of poor decisions. Volatility is what removes that cushion. Volatility doesn't create risk, it reveals it. In low volatility markets, risk feels small because price moves slowly. That's when position sizes creep up, leverage sneaks in, and discipline softens without anyone noticing. Then volatility returns, as it always does, and suddenly the same position feels unbearable. Nothing changed about the asset itself, only the speed and range of movement, but that change alone is enough to expose whether you were prepared or merely comfortable. What most traders miss is that liquidity and volatility are inseparable. When liquidity dries up, volatility explodes. When liquidity floods in unevenly, volatility becomes chaotic. This isn't emotion, it's mechanics. In stressed markets, bids pull back, spreads widen, and price has to travel farther to find real commitment. That's why crashes feel violent and rebounds feel unstable. Price isn't moving because opinions suddenly changed. It's moving because the other side of the trade disappeared. I remember 2008 vividly watching price slice through levels that had held for years as if they didn't exist. People kept asking how support could fail so easily, and the answer was simple. Support is an agreement, not a guarantee, and agreements only hold as long as liquidity supports them. When it doesn't price, doesn't negotiate, it hunts. Stops clustered at obvious levels didn't fail because they were poorly chosen. They failed because that's where the remaining liquidity was, and price had no choice but to go there. Volatility also distorts perception. Fast moves feel meaningful even when they're hollow. Thin markets can produce powerful-looking rallies that are built on very little depth. That's how traders get trapped on the upside, mistaking speed for strength and excitement for confirmation. When liquidity is shallow, price can rise easily, but it can fall even faster because the same lack of sellers that allows a spike up will leave you with no buyers when momentum turns. Liquidity defines time as well. In liquid markets, time is your ally. You can think reassess scale in and out. In illiquid markets, time turns against you. Hesitation becomes expensive. Decisions feel rushed, not because you're panicking, but because the market is no longer offering you many chances to act. That compression of time is one of the most psychologically dangerous aspects of illiquidity, because it pushes traders into reactive behavior just when calm judgment matters most. The COVID crash was a modern reminder of how quickly regimes can change. Markets assumed to be safe froze. Correlations snapped together. Volatility exploded. Strategies that had worked for years failed in days. The traders who survived were not the ones with the best forecasts, but the ones who recognized immediately that liquidity conditions had changed and shifted from optimization to preservation. They traded smaller, waited longer, and accepted imperfect execution as the price of survival. Over time, if you pay attention, you start to feel liquidity rather than just see it. You notice how price responds to size, how orderly or chaotic pullbacks look, how spreads behave when pressure increases. You stop forcing trades in environments that don't support your style. You realize volatility itself is not the enemy. Mismatch is. Volatility paired with the wrong position size, the wrong expectations, or the wrong emotional state is what does real damage. And this is where the deeper lesson begins to form. Because once you truly understand liquidity and volatility as living conditions, rather than abstract indicators, you stop asking how to predict them and start asking how to adapt to them, how to structure your risk and your behavior, so that when conditions shift, you are not surprised or panicked, but already operating from respect and preparedness. And that shift from prediction to adaptation is exactly where we need to go next, as we move from understanding these forces into learning how experienced traders actually change what they do when liquidity thins and volatility rises and the market stops being forgiving and starts testing whether you belong here at all. And that transition is where this conversation continues as we carry this thought forward and step into the practical side of surviving different liquidity and volatility regimes, when the pressure is real and decisions are irreversible, and you are standing there deciding whether to press forward or pull back, because that moment is where most accounts are damaged and also where the strongest habits are forged. And that is where we pick up next, as this sentence continues into how to adapt in real time, rather than explain in hindsight, by focusing less on what the market might do next and more on what you must change when the environment shifts. Because liquidity and volatility do not reward stubbornness, they reward adaptation. And the moment you insist on trading the same way through different regimes is the moment your edge begins to decay. The first practical adjustment is always position size. And I say always, because size is the only lever that works instantly. When liquidity thins and volatility expands, your tolerance for error collapses. Moves get faster, gaps get larger, and exits get less cooperative. If you don't reduce size early, the market will reduce your account for you, and it will do it without explanation or mercy. Alongside, size expectations must change just as quickly. In calm, liquid markets, you can afford to be precise. You can wait for perfect entries, target clean extensions, and manage trades with confidence that structure will hold. In volatile, thin markets, that mindset becomes dangerous. Precision turns into fragility. Instead, you shift toward ranges, probabilities, and partial outcomes. You stop demanding that price behave cleanly and start accepting that disorder is part of the cost of participation. Traders who suffer most in these periods are not the reckless ones, but the rigid ones, the ones who refuse to accept that the rules of engagement have changed. Risk management also has to evolve. Static stop losses work best when liquidity is deep and movement is orderly. In fast markets, those same stops often become magnets, not protection. That doesn't mean abandoning risk control, it means redefining it. Sometimes protection comes from smaller size and wider stops. Sometimes it comes from time-based exits. And sometimes the most disciplined decision is not trading at all. Knowing when to step aside is not weakness, it's a recognition that some environments offer poor compensation for risk, and patience in those moments is a form of capital preservation. Another adjustment that separates experience from theory is how you interpret signals. In volatile regimes, The first move is often misleading. Liquidity vacuums exaggerate price action, creating breakouts that fail and breakdowns that reverse violently. Experienced traders wait for confirmation in behavior, not just price. They watch whether pullbacks are shallow or chaotic, whether bids return consistently, whether gains are held or immediately given back. This kind of confirmation takes time, and time feels expensive when markets are moving fast, but impatience is exactly what thin conditions punish most severely. Emotionally, this is where many accounts are damaged beyond repair. Volatility amplifies everything. Confidence after wins becomes arrogance. Losses feel personal and urgent. If you're not careful, you start trading the last outcome instead of the current conditions. This is why routines outside the market matter more when volatility is high. Sleep distance and deliberate review become risk management tools. I have closed trades not because the thesis changed, but because I could feel my decision-making narrowing, and in fast markets that narrowing is lethal. Over the years, I stopped seeing volatility as danger and started seeing it as information. Rising volatility tells you to slow down. Thinning liquidity tells you to respect exits. Together, they tell you that survival, not optimization, is the goal. When you internalize that something powerful happens, you trade less but better. You accept missing moves without regret. You stop fighting the market and start aligning with what it's offering. After multiple cycles, this truth becomes unavoidable. Markets don't destroy accounts. Unadjusted behavior does. Every major blow-up I've witnessed came from traders who were right about direction but wrong about environment. They sized for calm in a storm, demanded structure from chaos, and paid for it. The ones who last are not the boldest or the fastest, but the most adaptive, the ones willing to look cautious when others look brave. And that is the final lesson I want to leave you with. Here, liquidity and volatility are not obstacles to overcome. They are conditions to respect. When you build your approach around adaptability rather than prediction, you give yourself something far more valuable than a single good trade. You give yourself longevity. If this lesson resonated, I invite you to subscribe to the channel so you can continue learning through real market experience rather than theory. And leave a comment sharing where a sudden shift in liquidity or volatility caught you off guard in the past, because reflecting on those moments is how you prepare for the next one, and there is always a next one in markets.